No surprise that we didn't see a move on the interest rates front, and it seems that inflation right now is relatively tame. We're starting to see a lot of money flowing out of the South African bond market and also out of the retail space. Given this renewed picture going forward, and also the fact that we could see food inflation coming to the fore, how would one manage their cash?
Well, I think you have certainly you have to watch the return that you get on money. You're taking risk by going into longer than immediate call deposits, but I think that risk probably in the short to medium term is something tenable, particularly if you put your money in the hands of some of the professional money managers and the unit trust managers out there, bond fund managers. Whilst there is volatility and there is pricing risk, the returns are slightly better. And the alternative to doing that is to earn a really lousy return after tax, because tax obviously is applied to interest and any form of income, and one has to worry about that. There also are a number of very capable, flexible money managers where you give the unit trust management company the right to move your funds from call through to short to medium term bonds. And again, if they're smart, and if they get their calls right, they can actually quite materially positively influence your return without exposing you to undue risk.
Well, it's interesting you mentioned short to medium term bonds as well. One of the sentiments that has been shared by a few investors and stockbrokers on the desk is that bonds are going to be out of favor this year. Do you think that's a wise scenario that could play out?
I think that bonds have a maturity date. So whilst you can in a bond portfolio get yourself into all sorts of trouble from a price at sale, intrinsic value point of view, if you hold a bond, clearly you're going to get whatever it says on the certificate at maturity. So the management of bonds is about getting the return right, getting the time or the duration, the time to maturity right. You can come very short. You can't just go out there and buy something because it pays 7 or 8% as opposed to money market rates at 6 or 5% without understanding exactly what those risks are.
Well, looking at the next interest rate decision, it seems that many were of the view that we could see another rate cut this year. Now, with renewed worries about food inflation and other inflation coming to the fore as well, it seems that the interest rate environment is going to stay flat for some time to come. It also seems that the interest rate derivative market is perhaps pricing in an interest rate hike towards the end of the year. Do you think that this is a possibility?
Well, having lost my last bet that I took on interest rates, Eleni, I probably shouldn't answer that question. I think that flat, lower for longer is a trend. Europe's in all sorts of trouble. It's trying to be frugal and try and sort its problems out. America has created massive issuance. It hasn't had the effect of stimulating the retail spend. So I think lower for longer still remains our call.
Now, all sorts of things are happening in the property market. One only needs to look at the Wendy Mechanic story, and of course Shemax still very much under the spotlight. What is your view on this sector and in terms of an investment opportunity as well?
Property is actually very closely allied to bonds, the capital market. It has an inverse relationship, so if interest rates go up, the value of bonds drop. Exactly the same with properties. If interest rates go down, the values of those assets typically go up because the cash flow that they generate is quite attractive. We find the cash flow out of property very attractive, either for an investor on the breadline or kind of with enough money to meet his or her needs or their needs. We find that rentals are quite interesting because if you buy quality property assets and you get this inflation-linked return, which is what a lease really is. Yeah. That's pretty interesting and it's sustainable. So if you're in the right location with the right tenant or the right manager managing those tenant mixes, then it's an interesting thing to do. The listed property sector through the period of tough times in markets has performed remarkably. That has come off a little bit. We're watching that closely. We have both individual trust and professional or non-taxed investors in those portfolios, and because they have different needs, one has to carefully look at what those are and try and buy the right asset class, which property is one of, and it's a major one of, to deal with that. On the subject of the problems that the Wendy Mechanic organisation are experiencing, on the Shemax issue, there are lots of risks out there, very significant risks out there. It is a time for the investor to be very careful, to talk to the regulator, to talk to their professional advisors or the accountants, just to double check whether what they are seeing on the can is what's inside the can.